Rob Roy, and welcome to the Elliott Wave Options S&P 500 U.S. market update. As the market itself continues to consolidate, I thought this would be a good opportunity to do a quick update on some of the other markets that we've talked about over the past several weeks. So let's take a look. If you're new to the channel, don't forget to drop us a like and subscribe to be notified every time we upload a new update. At the time of this recording, it is right at 1 a.m. on Thursday night / Friday morning, and at this moment the futures are up 32 points, so pointing to a higher open if they hold until the open. Looking at the market, you can see that we've consolidated into a triangle. It's a pretty nice one, but it's not very big, so it's a small symmetrical triangle with a bit of a tombstone doji there right smack in the middle of it, so we may not have to wait long for this to break out, but we've been really consolidating for the better part of a month, but just really forming this nice triangle over the past couple of weeks. We look at the major moving averages a lot, the 10, 30, and 50, but another moving average that we haven't looked at as much, but it's important and is interesting right now that I thought I'd share with you is the 200-day moving average. Look at where the 200-day moving average is, right at that 300 point. Remember, we've talked about how we could move up above this 61.8% fib resistance and fill that gap at the 300 level and still have a qualified downward zigzag, which that C wave to the downside I don't think would be a strong impulse move. As I mentioned, more of a meandering move, maybe throughout a boring summer, something along those lines. Quiet summer compared to what we've had. But wouldn't it be interesting if we broke out of this triangle, went up, filled that gap, tested the 200-day moving average, and then started the downward move? That would be a really clean setup. Market doesn't always set up as clean as we would like, but from that standpoint, it would work. Hey, before I forget, you can follow me on Twitter and Instagram. The details are on your screen and will also be in the comments section below the video. All right, moving on with the charts. So we want to look at the bond chart. Kind of where we've been, still in these triangles, but I hadn't shown them for a little bit, so I thought I would bring them back up. And you can see that we're just continuing to form larger and larger triangles. Tried to break to the downside on the 10-year and move right back up, and look at that dead center into the point of the triangle again today on the 10-year. And people have asked, well, when it breaks out, how's that going to affect the markets? Well, it depends on which way the bonds break. When the bond market moves, and this looks like a significant breakout coming, it will affect the equities market. And looking at bonds, you would think that would affect interest rates, and it has. We had a gap up in the TBT yesterday. Remember, this is exactly rates where the bond is showing prices, so they move inversely. So we had a gap up in rates, came back down and filled them. Also filled this gap over here. So the only gaps left now are way up here, which we wouldn't want to see if you want the market to move higher, to have rates go that high. That wouldn't be conducive to good things in the equities market, but it's a long way off. Those gaps will get filled someday, but it could be well into the future. Looking at the dollar, same thing. So still have the large symmetrical triangle forming. Looks like we're going to try to break to the downside and came back up. Again, just forming a larger triangle. So it sets up, and interest rates, the Fed, a lot of different things could affect what happens with the dollar and causes the breakout. But all these things are setting up, so it's likely all going to occur at once. Look at gold, and a lot of people ask about gold. Reminder with the Elliott Wave pattern that we are in a wave 3, but since we have the triangle set up in gold, that supersedes the wave 3, so you don't want to get caught up in looking for an upward breakout, although it looks like maybe that's where we're headed. And the interesting thing about this is you could kind of draw these triangles two different ways. I like the descending triangle setup, and you can see with that move today, it looks like we're trying to break to the upside, but we need a second day. You have to have that confirmation or follow-through day to confirm a breakout. So we had resistance in this area in February and March, and then that same area has been support since, and so that's why I like the idea of the descending triangle. But you could certainly make a case of bringing the lines down here and making it more of a symmetrical triangle. Same thing in SLV, and quite often people ask, why have you been trading SLV lately? I've traded both. We sent out alerts for our subscribers over the years in both GLD and SLV, but right now SLV is playing catch up. You can see that still have the triangle format. Maybe draw this one a little bit more of a symmetrical triangle with this doji here starting the move and the clean breakout. Well, here's the reason. See, the move to the upside today was 2.44% on SLV. In GLD, it was only 1.5%. So with this catch-up that I'm talking about, the moves in SLV tend to be, on average, a higher percentage, at least right now, than GLD. And I know SLV has ties with silver and electronics, etc. But GLD also has the Fed tampering around with, if you will, or intervention. So both of them have good points and drawbacks, but they do consolidate and break out a lot, which is quite interesting. Before I show you a chart of the VIX, which I do want to show you, I wanted to show you this chart, which shows that we've been pretty volatile, both to the upside and the downside. The VIX is still above 30, again, as I'll show you in a second, but you can see here that we've had volatility, not just on downward days, but we've had some pretty volatile upward days as well. So I thought that was interesting for you to see and take a look at. Looking at the chart of the VIX, we have this big descending triangle, and we're seeming to be meandering down to fill this gap that exists here. And if the market does break to the upside and goes up to that 300 level, the 200-day moving average, that could certainly be enough to fill this gap down here around 20. As we looked at the chart last, we had this area of support right around 40 with the lower highs that gave us a pretty nice descending triangle setup. We broke out of that and came back and tested it. Very common technical action for triangles. They break out and they come back to the breakout point, sometimes quickly like this, other times it takes a while. But if you look again with where we are now, a little bit of support resistance in that area, and then certainly with where we are now, so we could just go ahead and take this line and extend it on down to where the descending triangle is at this point in time. So everything looks like it's ready to break. We've got all kinds of consolidation, and I think if we don't see something on Friday, early next week, could be quite interesting. If I don't talk to you beforehand, have a wonderful weekend, and we'll be back to talk to you again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.